Balanced portfolios out of balance. The long-standing investment approach of 60% equities in the portfolio and 40% bonds got really busted up this year. For instance, the S&P 500, the equity component of that, was down 24% year to date as of the 9th of October, and treasuries are down 30%. This is a pretty substantial movement there, and very much different from perhaps what investors have come to expect over the last decades, really. This chart offers some clues on the reasons as to why, and shows the extreme risk that investors in standard 60/40 portfolios were perhaps unwittingly taking on late last year. First of all, what are we even looking at with this chart? The chart shows a portfolio weighted average valuation indicator, so 60% of the equity valuation indicator that I use, and adding to that 40% of the bond valuation indicator that I use. So these are the Topdown Charts proprietary valuation indicators. The messed up thing is that both treasuries and equities were trading more than one standard deviation expensive last year. That is not a recipe for success when you're hoping for one of those things to diversify the other. Usually what happens with a portfolio like this is that when you get an equity market downturn, bonds tend to outperform and help offset some of the losses on the equity side. This is basically Asset Allocation 101. The problem is that while equities were facing extreme risk at the turn of the year, so expensive valuations, crowded bullish sentiment and positioning, the pivot in monetary policy to tightening, bonds were equally facing significant risk, overvalued, overexposed to inflation risk, changes in monetary policy tides. So when you've got both components of a two-asset portfolio facing significant risks like that, it's never going to be a recipe for success. And as a minimum, this should be a prompt to ponder about your own asset allocation approach. The 60/40 portfolio approach worked for quite a while, but such a simple approach is arguably too simple. It's missing other important assets, and is missing an active process to control risk. The only things that really worked this year, the only things that went positive this year to date, on the asset allocation front have basically been cash and commodities. And so if those were other sort of elements or levers within the portfolio, there's a very different story. And for what it's worth, that's what we're recommending at Topdown Charts. Basically in our asset allocation tilts earlier this year, overweight cash and commodities, underweight stocks and bonds. Sometimes we get it right. You've got to pat yourself on the back a little bit when you get it right. But anyway, going back to this chart, December 2021 was actually the record high in that 60/40 valuation indicator, and in hindsight, you could say that 60/40 never stood a chance in that kind of initial setup. So look, if you like this chart, this was actually the bonus chart section from the latest weekly S&P 500 ChartStorm write-up. Be sure to head over to chartstorm.substack.com and subscribe to get that weekly mail out to your inbox each weekend.